You're welcome to your regular program, the DLM Bondshow, where we look at the bonds, the market, and the economy. Today, we'll be discussing the Eurobond and how its performance is really driving the Nigerian economy. To discuss the Eurobond and also a regular weekly bond watch today is Iyobosa EVBOSOMON. She's the head fixed income market for Don Lauren Merrifield. It's great to have you.
Good afternoon. Thank you so much.
And today we're discussing the Eurobond. We've heard about the Eurobond, and it's something that we really need to get further insight into. We heard about the oversubscription, $1 billion for the Nigerian bond market. So we're going to look at what it really means. But first, we'd like to know what the Eurobond is all about.
In practicality, if I may use that term, Eurobond basically gives like a sovereign the opportunity or the window to access the international market. So it's like a Nigerian country, as it were, going to the international market to issue a bond that is dollar denominated. So as against the federal government bonds that we have in Nigeria that are naira denominated, the Eurobond basically is dollar denominated. Now narrowing it down to the $1 billion Eurobond that was issued by the federal government in July 2013. I mean, if we had listened to the finance minister, Okonjo-Iweala, she had mentioned that it was specifically for infrastructural projects, typically the power sector. So I think, I mean, in a bid to raise funds, as it were, for the industry, the power industry, that's what drove the Nigerian government to access that window. And we found out that they issued the 5-year bond and the 10-year bond, and it was basically oversubscribed. The 5-year was issued at about 5.3, while the 10-year was issued about 6.6. Now, you mentioned something about the oversubscription of the bond. I think it was about...
That is what interests me.
Okay, the bond was about 400% oversubscribed. Now, I wouldn't really say that that was out of place, because if you look at market conditions at that particular point in time, it was a no-brainer for the bond to be oversubscribed. And why I say that is because in July, if we look at statistics, the average 10-year treasuries, US treasuries, was trading at about 2.6, 2.5 yield. So for an average investor, a foreign investor that is looking at where to place his funds, right, it only made sense for him to take up that opportunity that the Eurobond was throwing at them, which was 6% 10-year bond to a 2.5. Compare that's about 400 basis points difference. So it only made sense for them to place their funds in the Nigerian paper. Now, bear in mind that this is at no risk to them because the papers are dollar denominated, so they are not open to any form of exchange rate risk. So it might just be you might liken it to buying a US Treasury because it's a dollar denominated bond, right? The only risk you might see that it's okay, maybe they're taking up the sovereign risks of Nigeria. Now, you also want to look at the credit rating of Nigeria, as it were. Nigeria is an investment grade country. So, I mean, they probably would have put all of this into consideration before buying those instruments. And also, I think it would suffice to mention that at that particular point in time, way back July, that was when the Fed, Bernanke had hinted that he had mentioned something about you know, and then the market, as it were, went into frenzy because you saw a lot of sell-off in emerging markets. So you had foreign investors taking their funds out of emerging markets and looking for where to place these funds, because if you had looked at the Nigerian market, bond market at that particular point in time, you saw yields dropping you saw prices dropping drastically because there was a lot of sell-off. So you had bonds that were trading at, for example, the 10-year bond that was trading at I think 121, 122. I mean, at some point it went as high as 127. You saw these bonds coming down to about 119 in terms of prices. Those were foreign investors selling off. Now the question is, they were selling off these local instruments. Where were they going to place the money? And I think that it was a smart move on the part of Nigeria as a country to actually, that they issued their paper at that time, right? And I think that's why you saw that oversubscription, because you had enough funds floating around looking for what high-yielding instrument to buy, high-quality instruments to buy at that particular point in time. So, I mean, in terms of the oversubscription and all of that, that might be an explanation. Back home, it's also to a large extent to the advantage of the federal government, as it were, because we found out that if within the local debt instruments, bonds and all of that, were trading at about what, 16%, 15%. So it was significantly very expensive for the federal government to raise funds from within to finance these infrastructural projects that they had. So it only made sense for them to access the international market to raise these funds. Even the Minister of Finance had said something as regards that, and I know that at some point she had mentioned that the federal government is looking at reducing their borrowing internally, because I mean cost of funds to the federal government was quite expensive, and they were doing more like, should I use the term, like a portfolio shift, you know, looking at borrowing less this year as against what was borrowed last year. Because our market is basically tied to speculations in terms of foreigners coming and foreigners not coming, right? Because you're not really seeing domestic investors, you know, jumping on the bandwagon or buying bonds right now. Do you understand? So yes, in that way, it could have affected the market, and it did, because like we saw that a day 2 or 2 days before the announcement was made, before the Fed meeting, we saw a little bit of sell-off. We saw prices, not significantly, but we saw prices going down like a naira across board, especially on the 10-year instrument. However, when the meeting was held, before the meeting, we saw like a drop in prices, especially on the bond side, right? But after the meeting, I mean, when the news was that they were not going to go ahead with tapering and all of that, market readjusted to basically trading levels before the meeting. So it wasn't like market readjusted and then we saw a significant jump in price and foreign investors started coming in and bond prices started going up. Not necessarily. Prices just adjusted back to where it was before Benaki's meeting. So in that regard, I'll say yes, in terms of market sentiments and all of that, yes, it affects the market. For last week, I mean, the week past, we saw the CBN coming in to do OMO auctions, which is when they sell Treasury bills to the Treasury bills market. The CBN had offered about slightly over 300 billion, right? But they sold about, I think, 270 billion in terms of Treasury bills between 125 to about 185 days, if I'm within that range. So they had sold some significant volumes at that range. And I think the reason being that the FAC allocation had hit the system. We had about 323 billion that was released in FAC. And normally when FAC hits the system, it's very typical of CBN. They engage in their tightening measures, and they normally do this through the OMO auctions, which we saw them do significantly last week. And so you had going into the week, we had Treasury bills rates at about between 10.5 to about 11.5, but as at close of the week, we saw rates adjusting a little to about 12.25 levels, because most of the OMO auctions were done between 12 to 12.25. So you just saw market adjusting to those OMO levels. We expect that demand will keep, because I mean, the market as it is today, you find out that a lot of players are playing on the shorter end of the curve. And this is because there's so much uncertainty as to what will happen in the bond market. Do I really want to hold a bond at 13% when an effective yield on a 1-year Treasury bill or even a 180-day Treasury bill or 190-day Treasury bill is at about 12.5 levels? So people are beginning to question and beginning to look at their books again, and most of them are tilting to the shorter end of the curve. And even for most of the foreign investors, they are taking advantage of OMO auctions, they are taking advantage of the Treasury bills market, because the effective yield still makes some form of significant return, some form of sense for them, because it's still a positive return. If you look at where our where our inflation rate is today, still at single digit. So if you're getting an investment for 1 year at 12% effective yield, it's significant. That's like what, 4 basis points above 8% or 8.2% inflation. So people are questioning. So the activities you're seeing in the market is basically on the Treasury bills, and the bond market has been flat for 2 to 3 weeks, trading at about still trading around about 13 to 13.35 levels. So you're not really seeing activities on the longer end of the curve, which is the bond market.
The Eurobond being oversubscribed in the Nigerian economy, this means that Nigeria has become a market that can attract prospective investors and that can become one that can raise more capital to achieve great sustainable projects.